Well, good evening, everyone out there in Radio Land. This is Steve Reisler. Welcome to the public e-learning for the 9th of April 2019. I need a sight and sound check, please. Hello, Arnoldo, Rimal. Can you see my chart and obviously you can hear me. You get seasick most of the time, okay? I'll assume that the charts are okay. I can see it on my end here. All right, let's get started. What we're going to do is we're going to talk about trading gaps here. A little bit of background about me. I'm an ex-fighter pilot, and some of you already know me, like Arnoldo and others. But for those who don't, I've been an active trader since 1998 and a full-time trader since 2009. I'm basically a technical trader, but I do use some limited fundamentals. I moderate for H&R candlesticks from time to time if they need any assistance. And I also provide coaching. Disclaimer is that this is for educational purposes only, and their trading involves the... Okay, hold on. And how's that? Can you guys hear me now? Okay, fantastic. Okay, yep, I had a technical issue here. It is okay. For those who don't know me, I'm an ex-fighter pilot with master's degrees in both computers and business. I've been an active trader since 1998, full-time trader since 2009, and I do use a combination of technical and fundamentals. I moderate for H&R candlesticks from time to time and also provide coaching. Disclaimer is this for educational purposes only, and your trading involves the risk of loss of capital. All right, let's go into the meat of the matter here. Is why do stocks gap? Well, they're usually due to some report, a news item, or a press release. And scheduled events, things that we can know about in advance, are things like earnings, my favorite, conference calls, conferences they attend, market reports like the jobs reports, investor sentiment, and the like. Most of those, except for earnings and the conferences, they drive the markets pretty much the same, although if you might get some section or sector of the market that actually moves a little more than others. Unscheduled events, new contract award, you won't know about that necessarily in advance. Analyst upgrade or downgrade, and earnings guidance. And we're talking about out of cycle and not during an earnings report. Maybe an early warning or something like that. After this event, the price is going to rise or fall to meet the supply and demand. But the key question that we need to ask is, what's going to force the investors to react? And it's not about the report. It's about how the stock reacts to the report. There's so many people that I know of that talk about, well, this thing reported good earnings, yada, yada, yada. Why is it going down? Well, it could have gotten ahead of itself. It didn't meet expectations, obviously. So, if it was rising into earnings and it was getting hyped, then possibly it got ahead of itself in price. Okay. Why trade gaps? Gaps are often the beginning of a major move. And I'm not talking about day trading, I'm talking about actually swing trading gaps. And I'll show you how to do that. We can day trade them, but we could also do longer term trades like swing trades. The gap up after a down trailing move into that gap will create an upside reversal, and we'll look at some of those. And opposite of that, if we were going up and then suddenly have a downside reversal, you could have the opportunity for a nice swing trade. People caught on the wrong side of the trade. Some considerations for gaps. A lot of people say, "Oh, every gap up, I'm going to fade. I'm going to, go short." Well, do that at your peril, because not all gap ups are good shorts. Conversely, not all down gaps are good longs. You have to figure out whether it's gapping up on a logical reason, and that's starting to get into the subjective, I understand. But you can also see where it goes to. And not all gaps are filled, at least in the near term. And the gap in the opposite direction of the most recent prime movement is going to cause shock value, and we need to exploit that. We need to note where the stock is gapping up to. Is it gapping up or down to a support or a resistance level? How is it doing in relationship to the overall market? If the market's gapping up 2% and it's gapping up 1, it's not necessarily a good long, because it's not gapping up even as much as the overall market. That's relative strength. It could be, but not necessarily. And then you need to look at, what about the sector? Is it in favor? And the last one I'm going to cover here, I'm going to go into more detail later here, is that does it have high short interest? And what is high short interest? Well, short interest is a key factor is the percentage of float. I don't use anything else except that at the moment. And high is a relative term, but greater than, say, 10%, I think is a significant number. And you can get them on two places. And I'm going to bring up both of them right here. One is in a stock screener. I look at the earnings this week with average volume over 750,000, and I looked at the float short, and we've got a number of stocks here that fit that criteria that are over, say, 8 to 10%. And I'd be looking at those. Now, the fact is, RAD, I'm not necessarily sure it's going to rally, but you might get a rally, especially if the movement into earnings is in the downside, and you'll get people caught on the wrong side. Then you could do it. We can look over here, and one by one on short squeeze. What? No. 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 Well, looks like shortsqueeze.com just went down. Anyway, you go in your individually, you'll get the number a little bit differently than the stock screener, but I'll warn that both of those are anywhere between 2 and 4 weeks old. Okay. What effect will the gap have? So you put yourself in the shoes and seat of hedge fund manager. That may be short the stock, and suddenly the stock's going against him. It's going up. Well, how long is he going to let that go? And on the other hand, what is their boss going to be there? I'll walk over and tap you on the shoulder. Okay, thanks, Chris. That, hey, what's the story here? Where are you going to cover? You've got a lot of you've got a lot of shares out there. And let's just go over here. Let's look and see what RAD does here. Well, I get directory error again, so I got it to come up just a minute ago, but let me try something other than RAD. Let's try Western Ditch, and go down here, and it's 6.87%. And it'll talk to you about the increase and decrease. A lot of people talk about days, days to cover and whatever. In the old days, I used to use that, but now we've got the float. We've got digitally reported stuff, and I find it to work quite well. All right, we want to be able to exploit the pain there, so let's figure out how to do that. All right, there are some elements of a gap trading plan that one has to have. You have to look for the setups, and we talked about them a little bit on at least four of them on the prior slides, and we'll go over some of those in a minute. Um, Scanning. You gotta know how to find the darn things. Well, you could have a broker's gap list that they may or may not produce every day. You could use the live trading alerts software that I'll talk about on the next page here, LTA. An earnings list. I get my earnings list from briefing.com for earnings dates, and I filter those for stocks with enough volume that I would trade, 475, 480, 500,000 shares a day. And I eliminate those that don't have the average daily volume because they're not going to be good day trading candidates, and they might be lower than that. I don't even like to swing trade them. So what we do with that is I do on Sundays. I sit down for a few minutes. It only takes about half an hour, even during earnings season, to come up with a list of candidates that trade on a specific day, and I'll combine a list of stocks from the afternoon after the bell from the prior day, say Monday afternoon after the close, and Tuesday before the bell, and put it on their Tuesday list. Tuesday after the bell and Wednesday before the open, I put in a Wednesday list. And so what we do is we go in through those, and that's kind of gives me a heads up on some stocks to look for, gaps. If I when I wake up in the morning and come in about 8:30 and start looking at how the stocks are reacting to the news, and kind of come up with a list of maybe 5 or 6 candidates that I can watch, and then pick out my couple of best, and I can actually do study. And where I find those are on briefing.com, investor calendar. Let's see. Okay. Here's briefing.com, and go under calendars, earnings, and they'll show you today. I'll usually go to this week, and I'll start looking at that, and I'll go to a full listing. Make sure you do that because I only listed 2. Then up here, I step it to the days. The 10th, before tomorrow would be yesterday's, tonight's after the bell. Price Smart and WD-40, WDFC, and then I would add in Delta and MSM. And Bed Bath & Beyond, I believe, has high short interest this week, and then I go over to the 11th and add in before the open. All right, now I'm going to jump already to the 12th, because what I want to show you is that we have JP Morgan, PNC, and Wells Fargo. And Kathy, I'm going to go over that in just a little bit. If we have a follow-up question, please go ahead. Those are the beginning to me of earnings season. So this is going to be very apropos and very timely that you could probably try some of the techniques that we're talking about. Okay. Some of the other things that I look at on the week before is I start to look at what announcements are going to happen during the middle of trading hours that are going to possibly push me. Well, I go to a thing called Econo Day. And let's go up here. I do econoday.com, and I come down to view full calendar, and then I look at the week. Well, things that jump out at me are the reds. Some of these are before the market. In fact, a lot of them, the reports are, but some are not. Like the JOLTS report, that's jobs report, comes out at 10 a.m. Consumer sentiment, big time on Fridays. I don't see that gas as a biggie. Petroleum report, I trade the report every Wednesday, but one that's going to be a biggie this week? The FOMC on Wednesday. And if we don't get the reaction necessarily on Wednesday, we could get another reaction follow up on Thursday. So watch for the FOMC. we got to get, we can basically know that if we're day trading, we may not want to be in any positions ahead of the FOMC release and or the petroleum report. You wouldn't necessarily want to jump in ahead of that report. Okay, let's go ahead and let's look at the trade management. We're going to be looking at that. That's primarily the focus of this presentation, is going to be on entries and exits. Okay, and the setups. We're only going to talk about 30 to 45 minutes here tonight, but we could probably talk for 3 or 4 hours on this subject. A good entry has good profit potential. A bad entry, potentially huge losses and rather quickly. Money management, risk management. I use multiples of the amount of dollars at risk. Like $100 I want to risk, 200, 300, 400 on a trade. I set up a dollar amount that I'm willing to risk, and that is created by looking at the entry, going all the way down to where the stop is, finding out the difference, and if the difference is $1, and I'm only going to risk $100, I can buy 100 shares. If I want to risk a maximum of $200, I can buy up to 200 shares. And I have a whole minor presentation on share sizing. Well, here's some earnings and pre-market mover lists from Thinkorswim, and you can sort them by different categories. Those who have Thinkorswim, I strongly suggest you use Mark and not Last, because Last will not show you the pre-market or the after hours. I use Mark change, and Mark percent change. I use volume and obviously the symbol. All right. And you can sort by volume. You can sort by the absolute dollar amount movement, percentage, and like the ATHX is $1.57.5. I go, I'm not even interested. I don't care how many shares they're trading. That's just personally, I don't like to trade stocks that are under about $5. So it's very difficult, if not impossible, to filter those out in Thinkorswim in a timely manner, that is. So I just usually get through the biggies that I can recognize. All right, I did say I would talk about the LTA scanner real quick. Put a little plug in here. Ed Carter is the father of LTA, and it does a live scan of the markets for favorable setups and patterns. There are dozens, and I'll repeat, dozens of setups and patterns that it scans for live in real time and presents them to us. 2 of them are bullish and bearish gaps. I use those plus others and find them. Ed said there's going to be a free webinar here in room 4 on the 11th at 1:30 p.m. Eastern. If you're interested in finding out a little bit more about that, come on back. No password required. Here's a little bit about what the LTA scanner is and can do. And Ed, if you want to post out some links out there to information on LTA, I'd be most appreciative. The types of gaps that we got out there were the gap reversals, the gap over or under area of consolidation. My favorite, a gap and crap. Gap and snap, where the gap's down and then snaps back up. And they're just 4 of the several types of gaps that there are. Maxim, I'm going to go over that in just a little bit. Thank you very much for the question. This gap reversal is obviously zooming way up here and pulling back. And one of the things that's logged me in here, I'll tell you, you know what? This gapped up, and it's had a huge run in this direction. It reported earnings after the bell and came crashing down. So this is an abandoned baby up here. This one started to get too far away from the moving averages, away from the mean, and we had a reversion to the mean. Some gaps are selling opportunities. We had Earnings reported here. It gapped way up and did a high wave doji, and then opened up down here around 97. Did close higher to close to 100, but the net of this is down. I like the little cartoon here, so this is where I usually start screaming. When you get up here, you go, yeah, which way is it going to go? And thank you very much. Appreciate that link. A gap over a prior swing level. And we had a gap here in Schmuckers. And it had been down in the prior earnings release and kind of bounced around. And then we got close to the $108, $109 level. And suddenly we gap up to this prior swing level and just run like a scalded dog. People who were short this one were probably using either this level right here around 111 or this level here around 113 as their stop levels. Now we can look at this and say, you know what? I know, and I'll mark up, and that's where these numbers are, these dotted lines, dash lines, sorry. These dash lines are pre-marked saying, you know what, if this thing gaps up over that, it could run at least to the 111 level. If it runs over that, we could run up to probably where this level was here, and maybe even higher. Well, it ran in one day from about 111 to 116 and a half. Nice trade if you could get it. All right, gap over a prior swing level. This should give us a clue that there's a very, very, very strong interest in this stock, Dollar Tree. All right, and it gapped up above that level, and you can see how it continued to move up and to the right after even that first day. A lot of sometimes, if I don't get in at the end of the day on these swings, I'll look and see what happens on the next day, and if it moves up above the body or sometimes the wick of the prior day, I can go long. On this one, I probably would have used a fairly short dated option, probably 30, 45 days, and watch for this to go and do a 45-degree move. Why is that going to happen a lot of times? Because it gaps up over an obvious resistance level. And as it continues to creep up higher, those who were really quick on the trigger got out early. The people that saw this for the first time jumped in. There's all kinds of people that are interested in getting in this stock. People who have the stock are not going to let go of it. They may buy more. People who are watching it and waiting for it to prove itself. Once it gets above this level, it says, yea, verily, I believe in you. And the people who are short, they got to figure out at some level they're going to cover. Yep. I saw those. I use them. A gap under consolidation. Although this is really more a trading range, you could call it a consolidation. But when we gap down, again, on what? On earnings, on Superior Energy, boom. Set ourselves up to move down to this volume level at price here around 15. Probably a good candidate to short, or definitely if you're long, telling you it's time to exit stage left. All right, I use a 5-minute opening range if I'm going to go long, and would that be either a day trade or a swing trade. But if I'm going to go long at the open, I'm going to let it go for anywhere from 2 to 5 minutes, minimum of 2. But I try to do 5 minutes. That opening range, if it doesn't break out above either the high of the body or the high of the candle wick, I don't want to be in it because it's not proving that it can go higher. In fact, with the body here being, opening here, going as high as 57.80 and closing at about 54, I'm not interested unless it starts to curl back up, and then I'm only probably going to expect it to retest the high, and then I'll evaluate whether it can continue to go higher. But this one obviously didn't reverse itself, and using the 5-minute opening range for our trade would have kept us out of a bad trade and potential loss. Let's look at what happened to Signet, SIG. This is a gap and crap. Where did it gap up to? It was sitting here. It had earnings and it gapped up to just under 100. And just happens to be where we had some congestion over here to the left. I believe I've mentioned it a number of times there, Eric. It's not. I don't think I have a specific presentation on it, but we're going to go over it a little bit here in a few minutes. Signet right here, first 5-minute candle, got a size 101.46, but then it came down, and we never got above. We got just barely above the body, but never got ahead or above that that wick. It's going to be a decision part on your part when you're trading as to whether you insist on it get above the body or above the wick. Sometimes waiting for it to go above the wick is too much. You're going to have to get in a little early. But I definitely say above the body and then a little bit more is probably the safest bet. No trades are safe, but they're odds. All right. We basically got no follow through. Gap and snap. Here's one from Dollar Tree a while back. It gapped all the way down here on, as it's 2016. It gapped way down here to 72 and a half, and then suddenly came roaring back up. Then it kind of pulled back and did an intraday J-hook before it continued to go back up and fill the gap. Well, here's another one. Many times that gap is down to a support level, and I do believe the gap and snap on Dollar Tree, the 72.50, I believe was if I can remember that trade, was down to support level. So you could possibly anticipate that. You can see where kind of a support level here, the tops of these candles over here. Magnolia, MGY, gapped down to that level, moved lower, and then closed up. This is a bullish sign, especially if we can move up on the following day. Here's where you can take that gap, put it in a watch list. If you're not interested in going long it on that day, watch it for the following day. And where would the target be? Potentially somewhere up into the middle of this congestion band here. So somewhere from about 11 and a half or a little bit less to 12 and a half. That's somewhere around 8%. I think I'll take that. All right. Signal of a big move coming. When we had Barry out here, the first day right here, it moved up, had high volume. It got through the swing level and closed above it, even though it got a little higher and pulled back. The second day entry over here in the second green candle would still have been a very, very good entry. Entered a little bit below 28, and 30.50 is what it closed here from what I'm showing you. In fact, I believe this one actually, no, this was the one I traded on a swing basis. Swinged here after it proved that it was going to stay above this $27 level. And I got out thinking I'd had a pretty good run at 29 quarter, 29.50. It ran another dollar above that, and I was sitting on the sidelines going, oopsies. But I was happy to take my money out of the middle. Yes, Eric, the 5-minute is, the first 5 minutes is what I call the amateur time of buying. People who are talked into it by their broker, people who put in market orders, and they put in market orders probably from news in the prior day or news that happened before the open. And it takes about 5 minutes and sometimes only about 2 minutes, and that settles down. And that buying impetus dries up in a hurry. Most of the time, not all the time, but most of the time that happens when there are things like analyst upgrades. Analyst upgrades, other than Goldman Sachs, don't have any legs at all. They're measured in minutes. Um, Goldman may have a day or two. They're losing their luster as far as how much impact they're having on the markets nowadays. But things that are driving straight to the bottom line, either new contracts or even the earnings guidance, they're going to have legs. So if you see a reaction, a really good reaction above consolidation and trading ranges, you can go long or break down below them. All right. I'm going to go over some, right now, up to now, I've really been only talking about daily charts. Well, I'm going to go over some day trade examples. Now, I'm going to remind everybody that, earnings season begins this Friday, according to me. I don't use Alcoa anymore. I only gave it lip service before, but it's basically the financials lead us off. All right, I'm going to go over Java from a couple of years back. And this was the daily chart before its earnings release. It basically had earnings and moved up to about, I guess that's about $8.25. Then it did what I would call a cup and handle. Because of that daily pattern, I'm going, well, if it reports decent earnings, it'll blow right through 850 and go higher. I'm going to be ready for it. And in the pre-market, I noticed it was going to gap up into the above $9 level. So I'm going to let the first 5 minutes candle settle down. And I basically said, you know what? I might say 5 minutes. These are 2-minute candles, 2, 4, and this is 6. And I'm saying, okay, it's going higher. The volume is decreasing. So I got to look at it. And I'm going to let it go over 950, make it get over 550. And I'm going to have a stop under 9 1/4. Why 9 1/4? Because it's under this candle here. Because if I get above 950 and it comes all the way back to under 9 1/4, it's not going in the direction I expected it to go. If it doesn't go in the direction I expect it to go, get out. All right. And I'm risking 25 cents there. Well, how many shares am I going to buy? Well, if I'm going to risk 100 or want that a max, I can buy a maximum of 400 shares. And why do I say maximum? Because I could buy 300 or 200 or 100 if it's maybe the market is gapping down on this day. Maybe I normally risk 200 shares on a trade and I want to go back down to $100. You can vary this, but what this says is for this $100 risk, the max I can buy is 400. All right, I normally try to get my first target, or have been in the past, trying to get 2 times risk. I sometimes will go down to 1.5 now, if we don't have the volatility. And that second target, I'd like to use a trailing stop after some sort of pivot or on a big spike. And I'll talk to you about that in a second. All right, we're still on a 2-minute chart, and we went long, 950, and it moved very smartly up to about $10 and ran into some sellers. Well, I sold a little bit under the round number of 10, 1.8 times my risk, and I moved my stop to break even on the back half, waiting for this to potentially pull back and do a curl down. Now let's see what we got here. Want to make up to here, let it pull back, and go there. Now, because I've taken the money out at approximately $10 and my stop is break even, I'm playing with house money. I can't have a losing trade here. I love it when it happens like that because it makes it nice and easy. All right. Here's the long, that's the first sell. There was the stop. It did the curl back and it moved up to about 10.5 and pulled back. Notice how it's moving in waves, and it moved up here. And once it got to 11, I've got almost 6 times risk in there, so I took off a quarter. What's a quarter? It's 100 shares. So I had 200 shares at basically 50 cents each. So I had $100. And then I'm not counting up my money while I'm sitting here in the trade, but what I'm doing is I'm showing you that I'm moving the ratcheting the stop up. And then once I get to a significant amount, I need to take some money off the table. Yes, you can. If say, let's just say, Gary, if you didn't see Java and it did this and it did a pull back here, two ways. You could either go long right here after it curls up or wait for the breakout above 10. On this case, since it didn't pull back really hard, I'd wait for a move up above 10. And I'm going to cover one in just a little bit about how you'd some targets, but that was an excellent question. All right, now at some point along there, I'm going to get off a 2-minute chart. I'm going to move to a 5-minute chart. I try to do that at somewhere around the 9:45 point. And you notice here around 10 o'clock, we had our pullback and we had a move up pullback. This is a zoom in on the part of that prior chart. Okay, whoops. And we zoomed in on this chart right here. Okay, so got to 11, we took our second. And I think I moved it up. I'm not even going to cover what the last was, but I think it just kind of ran out of steam. Probably around 11 and a half, 11 and a quarter, and I ended up getting stopped out. Well, I got stopped out for a very nice profit on the last quarter. The idea is to set up your reward and risk ratios that are proper, in my mind, about 1.5 to 2 to 1, and then manage those where you take profits incrementally. Now, I have extremely low commissions, so I can do this. Some people who are paying $4.95, $7.95, $9.95 per trade, you may not be able to do that. You may not be able to do them off in quarter increments on 100 shares. Heck, I could trade 25 shares of Apple and still be able to make money because it only cost me $1. All right, so having good low commissions is important, and if you don't have those, then you may have to do things a little differently than I do. Hal's coming up on earnings, and this was the weekly chart, and I wanted to see, because I really could see some here around the 47 level, but then I said, well, what's going on back here? Well, we had maybe 58 and a quarter, but the bottoms of these right here are right at about 54. Right where it stopped just before earnings. Well, Hal got up to just about 54, about that resistance level, and I said, you know what? I'm going to make it break a little bit over the body here. I can't go all the way to the top here because that's another 40 cents up there, and I'm not going to have it stop all the way down here. So I'm going to make it get above this 54.10, and I only have a 20-cent stop because if it comes back down here, I don't want to be in it. All right, 2 times risk is, since I only have 40 cents at risk, I've only got 20 there, but 40 cents total. I'm going to take it right here at 54.50, and then the trailer would be trying to get it as high as we can, and I ended up stopping out at 80 cents profit. So, and this, I didn't say whether this was 10 shares, 20 shares, 100 shares, 1,000 shares, because it really doesn't matter unless it tells you how much, because I have 20 cents per share, I can buy 500 shares and risk only $100. All right, here's how could be done on a intraday swing trade. Let it move up, let it go sideways. We did kind of a shooting star, but shooting star, and as most candles patterns, they need confirmation. and I would make it move up above this 54.75 or so, and then it moves up and it moves sideways. It moves up and it moves sideways. Now, this is how you would also play. Let's just make this, instead of being a 30-minute chart, make the assumption that this is a daily chart. Well, this is the big strong move up. That right there is a sideways move. This is a 1, 2, 3 continuation move. It's a move up, sideways, move up as it gets above the highs in there. And where's the stop? Below the low of the candle that brought you in. And eventually you can start moving up to the prior candles, and then you'd have to stay here for a while, and then you could move it up. These green dots, if anybody is asking, are volatility stops. Now, it's a whole different story about what and how to use volatility stops, but one of our trusty moderators took this is built in within TC2000, and he did a study for over a couple of years actually, and found the 10 period 1.5 a delta basically, standard deviation works out really well. 1.5 works really well for nominated and notional stop levels. And notice how this stays flat when price levels off. What it wants to do is it wants to give this enough room to work. Sometimes these are too far down. If this is going sideways and I've got a lot of money at risk, as it goes like that, I might raise my stop to halfway. JM, that's going to have to be a personal preference. My own personal preferences is I will start off on trades watching the 2-minute chart. I'm not trading necessarily a 2-minute chart. I'm trying to let it go to 5 to 6 minutes into the day. But I'm watching the 2-minute because I'm basically drilling down to see what's going on intra-candle. After about 15 minutes, I want to get onto a 5-minute candle. And after 11:30 or so, I go to a 15-minute candle. Now, I have found from my journal entries that I make really good money in the morning. And I tend to do less well in the afternoon. So right now, I tend not to trade in the afternoon at all. And it allows me to do other things in the house or outside the house, like playing golf. Things I like to do. So you'll have to figure out what works for you on your trading style, but those are what I use. I'm going to talk about some swing trade examples. Oh, you're welcome, JM. When options trade, when gapped up. And we said, you know what, we're going to make it get above this 188 level. So it kind of gapped up and it kind of consolidated that move and started to digest it. And I think we bought 2 or 4 options on this one. And they were making some decent money here. By the end of the day, we'd already got up to 195 almost. So we had a pretty darn good profit there. So we sold half of ours at the end of the day to lock in profits. Because who knows what tomorrow will bring. Well, tomorrow brought a gap up and a move up a little higher to the $200 level. Another psychological number. And we could see it. We were watching. So what are we going to do here? Well, 200 now we're on the daily chart, and we get ourselves this doji here. A doji is a sign of indecision. Whichever way it goes after forming that doji is the way it's going to, is it going to resume the trend by going higher, or is it going to reverse and go down? We don't know yet. The title of this slide is When to Sell, Don't Get Greedy. Remember, we moved up from below 190, around 188, to 201, 202. We made, I think, somewhere in the neighborhood of 48% profit in 3 days, 4 days of this trade. Should we be taking more off the table? If we had four, we sold two, maybe sell one more, so we're not. Well, now we went to a 30-minute chart on that next day, that Thursday, and everything was going hunky-dory on the Friday until suddenly there was news about the CEO, Steve Wynn. Some inappropriate behavior type stuff coming out. And the stock tanked. So did the options, probably even more so. All right. Unscheduled news. All right. We don't want to initiate trades in after hours. Why? First of all, it's very difficult for some of us to put in the limit orders that they are required. It's not necessarily a one-button push. And the other thing is you usually get a lot of volatility. The stock can move, price movements up and down. I strongly recommend people who are day trading, trade during the regular trading hours. Wait till 9:30 the next morning. Unless you just happen to have this and you traded it over, that move up would be a time to take profit, at least on some of what you got. Oh yeah, you hate the big red candle. And when did it happen? It happened when they started talking. When the conference call in after hours happened at 4:30, they liked the numbers, and then suddenly they didn't like something. It could have been an explanation of the numbers, or it could have been guidance. And in this case, I believe it was guidance. A lot of times when that conference call is, and I want to know when the conference call is. If I'm trading the next day and it's during regular trading hours, and the conference call doesn't start till 9 or 9:30 Central Time, I'm either a little bit leery of getting in, or I'm going to be out before the conference call, or be into playing with house money. So know when the conference call is going to happen. All right, I'm going to go over some recent examples of stuff that trades that can CERN. I'm going to do the daily. CERN daily gapped up today. Where did it gap up to? Somewhere, that's where it gapped up to, and when it gapped up to that, it's somewhat in the middle of this mishmash here. Let's go look at the 5-minute chart. Did this one suck us into going long? Probably. But guess what? Once it came back down in here, volatility stop said limit your losses to 64.40 at a maximum. Once it starts going against me after getting back up there, I probably would have been out. I did not trade this one this morning. NEO. Let's go back to the daily. NEO gap up. Back over here, gapped up, and then continued to smartly move through about the $20 range. $20, could you have put 1950 as the top here? But what about the wicks? Well, let's take out of the wicks. Where did it go to? It got through the wicks and it came back down and kept bouncing off of the top of that. Take a look at this and line these up. Depending upon how much short interest there was for NEO, it was showing, I don't really care what happens, it was showing that $20.30 to $20.25 was showing up as support. It's confirmed that support. MongoDB. We played this MongoDB back here. The gap up, very high, float short. High probability trade. I day traded it, and then I got in the next day on a longer trade, on a swing trade. Used options and bought 2 contracts, sold one, I think, right about here where it did kind of a mini doji here. And when we gapped up along in here and then pulled back sideways, I got out. It basically did a 45-degree run. This right here, that candle, big spike runner, getting way too far away from the mean, from the moving averages. See how far it's getting away from this purple line? That's my 17 exponential. We get too far away from it, eventually it's going to have to normalize itself. Don't get greedy. ZS. Good move up on earnings day. Next day negated it. It stabilized here at about this $57 level and then started its 45-degree run. Let me show you the Fibonacci expansion here. All right, if I take it from right here, I know it's not perfect, and take it to that first or the second day when it got up to, it came back to somewhere between 0.382 to 0.50 retracement. Nice, perfect. Jump in there, maybe here around 58 and a quarter with a stop at about 56.75, $1.25. Yeah, it moves quite a bit. It has an average true range of $3.66 a day. That's over 5%. Okay, so maybe only buy 100 shares instead of 200. All right, then we risk ourselves a $1.50. And where's our first target? Our first target is at that prior swing level. Is it the body or is it the top? You tell me. The stock will tell us. Stock will tell us when it stops moving up. It was telling us somewhere around this level that it was starting to run out of steam. It did come back a little bit later after a sell-off day, but it didn't get much higher. Okay, workday. Let me go over here to the left. Workday, gapped up, kept on moving. 45-degree runner. Played this via options and let it do its thing. Workday moves $5.63 a day, about 3%. You have to give it room. Hopefully you have more than one contract and you could get one out when it does this move away and starts to come back to that blue line, which is the 8 exponential moving average. Cuervo, let's go over to the left. And Cuervo, actually, I don't move left, it's right here. Cuervo gapped down. It got a move up here, pulled back. It gapped down to where? It gapped down to basically prior support levels. Let me say that it's pretty much like that. That's kind of the support levels. And then it started moving back and climbed back higher. Watch for gaps down to support level that you don't short it after it's already had its run. Don't go long at resistance. Don't go short at support. Autodesk. Let's go to the right. Autodesk. What does she have here? There's a swing level. Call it 159. Once it gapped up and started smartly moving through that, there's probably some sort of resistance in this overlap area right here. And I'm going to go to a 60-minute chart and see if I can see it. Wait a minute. Let me do that on here so I can get the... There's the hourly. And I can see it right there. And we did actually get up to this and pull back. You see how we got up to that 161. And then we got over it. And then we have what I call a waterfall. All the way up here to all the way down here. I treat that as having no resistance whatsoever. And what happened? We went all the way up to about this level and then gapped up and went all the way up to this level right in here, where that 60-minute chart is. This right here is a waterfall. Go, and this is an overlap. Go down and drill down into a 30 or 60-minute chart and find out where those levels are. And we took this candle, which looks like it didn't stop. Well, we know that it did. It paused a little around 160, 160 half. Last one we're going to look at is PNR, Pentair. It gapped down. It gapped down to what? It gapped down to support level. But guess what happened? it kept going lower. Let's take it to a 5-minute chart. What did it do? It stabilized there and tried to hold for about the first 5 to 10 minutes. Then it sold off a little bit. Then it rallied a little. Then it ultimately failed. Look at these and find out what you want to do. You want to do a quick hit and run? Do you want to wait for these and then fail? I'm surprised actually that this didn't go lower, but maybe I'm not. If it goes from 45 down to 40 and a half, that's $4.50. That's over 10% down. How much more do we expect it to go? The reason this one didn't go much lower, it went down to this $39 level. I think it probably has more to go down tomorrow because there doesn't seem to be any logical support level. But that was about all it could stand for one day down. All right, let's see. We're done with those for the moment. We talked about briefing.com and FinViz. All right, we had a question above, and oops, I don't want to do that. What I want to do is try to find out who was it that had the question? Kathy. Do you actually place the trade before the bell to catch the up or gap up or down? No. I let it go for, like I said, the first 2 minutes minimum. 5 minutes, I'd love to do that. All right. Do we have any other general questions? Now remember, bulls make money and bears make money, but pigs get slaughtered. Don't try to force a trade. Let the trade come to you. If it runs away from you, you've been watching it and it ran away in the first, you're trying to wait the 5 minutes and suddenly it's already way, way, way too high for you. Just say, well, not my day. Thank God there's always another trade. All right, DBO. Any questions out there? We've been going for about an hour. All right, I'm gonna do one thing. I'm gonna bring up my Thinkorswim chart real quick. I have to log in because I've logged out already. 1 second. I'm going to give you a little bonus here. Come on, baby. It's installing the updates. Any questions? Hey, Walter. You're welcome. Well, why don't we do it this way? All right, I've got these pre-marked already. This is the S&P 500. Notice how we got up to this level around 2817 once, twice, kind of 3 times, 4th, 5, and then we kind of wobbled around it, and we went up. I am a proponent of stochastics RSI. It helps me judge momentum. And what we did here is it looks like we're doing a little bit of a pullback. The first level of defense is right about here around 2850. And if we go below that, we're looking at 2820 to 2800. So watch out. The pullbacks have not been that deep yet so far. But one day right here got really scary back on the 22nd of March. Let's look at the Qs. The Qs are marching up. I don't have them marked, but basically they're getting awfully close to the all-time highs back here in October and September. The Russell IWM. This Russell does not look healthy. Notice how we've got the 200 period moving average is actually sloping downwards. And It just does not look healthy at all. We can't get through the 200. Can't get through. I'll call the level here around 1600 on RTY and 160 on that. Now let me do one other thing. I also use EMA chart, and I look at the 8 and the 17 and try to see what they're doing. Right in here, we're in a perfect uptrend. Then we have some doubts here, and we're still in doubt. In here, this area right over here in here, we're in a downtrend. Then we're trying to figure out whether we want to go lower or not. Well, it broke lower. So if you can stay on the side of the trend, you will make money in the markets. If you stay out of the chop, you'll avoid the losses. All right, what's the other thing? Okay, I want to do one more, and that is T2122. All right, and I use line chart, and I have a pullback zone and a bounce zone. The green dashed line is what I'm looking at, and this is the percentage of stocks making 4-week new highs versus those that are making new lows. So it's 0.6. So we've got a little bit more, a few more stocks making monthly highs that are making monthly lows. Every time we get up here in this 85 to 95% level, we get some sort of pullback. Every time, absolutely every time we get down into this really way oversold condition, we get a bounce. Nowhere in here do I know how big the pullback will be, nor how big the bounce will be. I just know that it's going to happen. And some of them you see right on here, there for a while in January, February, almost 2 full months, we were getting almost daily reversals. That was wacko. I don't know that there's anything, because T2122 is a proprietary indicator for Worden Brothers TC2000. You might want to look and see if there's a 4-week new high, new low. If there is, fine. I've never looked, and I don't have my Thinkorswim up, so I can't look at the moment. All right, any other questions? I want to thank everybody for coming out tonight and listening to us. We do have, we'd like to see more of you. Think about coming over to the, and taking a trial offer, a little, let's see, where we got here. Hit and run candlesticks. All right, 60-day trial offer. That's 2 months. By 2 months, you'll be able to figure out what you, figure out whether you like us or not. Come on in. H&R, hit and run candlesticks are right way options. Give it a shot. I think you'll be pleasantly surprised. All right, take care, folks.